AS2, Inventories, from cost to real value. Hello, and welcome to Candymentor. In this session, we'll decode IND AS2, the standard that tells you how to account for inventories, from measuring cost to recognizing expense and valuing closing stock at the right amount. By the end, you'll know how to calculate cost, handle write-downs and reversals, and apply FIFO or weighted average properly. Objective of IND AS2. The standard's purpose is clear. Decide how inventory should be recognized and measured. It tells us what cost becomes an asset until revenue is realized. It insists on valuing inventories at the lower of cost and net realizable value, NRV. The result? Consistent profit measurement and a reliable balance sheet. Scope and coverage. IND AS2 applies to inventories held for sale, production for sale, or consumption in production. But a few items are excluded. Construction work in progress under IND AS 115, financial instruments under IND AS 109, biological assets under IND AS 41, and producers' inventories measured at NRV or fair value through profit or loss. If your item is excluded, use the relevant standard instead. End. What is inventory? Inventories are current assets you hold to sell in ordinary course. Items in production for sale, or materials consumed in production or service delivery. Common examples: raw materials, work in progress, WIP, finished goods, and stores and spares used in production. If it's held for sale or conversion to sale, it's inventory. Measurement principle. Measure inventories at the lower of cost and NRV. Cost captures what you spent to bring items to their current location and condition. NRV is the estimated selling price in the ordinary course of business. Less cost to complete and sell. Always compare cost and NRV and carry the lower amount. Components of cost. Cost comprises three buckets. A. Cost of purchase, purchase price, import duties and non-recoverable taxes, transport, handling, and other directly attributable costs. Less trade discounts and rebates. B. Cost of conversion, direct labor and production overheads. Variable overheads allocated based on actual use. Fixed overheads allocated on normal capacity, not on actual lower production. C. Other costs. Include only costs necessary to bring inventories to saleable condition. For example, special design costs for a bespoke order may be included. Keep allocations reasonable and document your basis. End. Exclusions from cost do not capitalize abnormal waste of materials, labor, or production overheads. Do not include storage costs unless they are part of the production process. Exclude general administrative overheads not contributing to production, selling costs, and distribution costs. Interest is excluded unless the inventory is a qualifying asset under IND AS 23. Cost formulas for valuation methods. Select a consistent cost formula when items are interchangeable. FIFO. First in, first out. Oldest costs go to COGS first. Weighted average, average cost of items available during the period. Specific identification, used for unique or high-value items, cars, jewelry. LIFO, last in, first out, is not permitted under IND AS. Example: FIFO versus weighted average scenario. Opening 100 units at 10 rupees. Purchase 100 units at 12 rupees. Sales 150 units. FIFO, COGS equals 100 times 10 rupees plus 50 times 12 rupees, 1,600 rupees. Closing stock equals 50 times 12 rupees, 600 rupees. Weighted average, average cost equals 100 times 10 plus 100 times 12 times 200 equals 11 rupees. COGS, 150 times 11 rupees equals 1,650 rupees. Closing stock equals 50 times 11 rupees equals 550 rupees. The choice affects reported profit and closing inventory valuation. Allocation of fixed overheads. Fixed overheads should be allocated based on normal capacity, the expected average production under normal circumstances. Example, fixed overheads 10,000, normal capacity 10,000 units, actual production 8,000 units. Overhead rate equals 100 rupees per unit. Unallocated overhead for the shortfall, 2,000 rupees, is expensed in P&L. This avoids inflation of inventory costs when production dips. Joint products and byproducts. For joint products, allocate joint costs up to the split-off point based on relative sales values. Byproducts are usually measured at NRV, and their proceeds are deducted from the main product's cost or recognized as other income. Example, in refining, allocate joint costs across petrol, diesel, and bitumen by relative sales value. End. Net Realizable Value, NRV. NRV equals estimated selling price minus estimated costs to complete minus estimated costs to sell. NRV reflects the recoverable amount from inventory. Compare NRV with cost on an item-by-item basis, or by product line when appropriate. If NRV is less than cost, write the inventory down to NRV and recognize the loss in profit or loss. Write down and reversal. If you wrote down inventory because NRV is less than cost, you must recognize the loss immediately. Should NRV recover later, you are allowed to reverse the write-down, but only up to the original written-down amount. Example, cost 100 rupees, NRV 80 rupees, write-down 20 rupees. Next year, NRV 95 rupees. Record the reversal in the period of recovery. Service industry inventories. Service entities may hold inventories representing costs of services not yet earned. Include labor and overheads directly related to the service. Do not include profit margin or general administrative overheads. Treat these like work in progress for service contracts. Borrowing costs. Capitalize borrowing costs only when inventory is a qualifying asset, meaning it takes substantial time to get ready for sale. Examples, aging whiskey, a ship under construction. If not qualifying, expense borrowing costs as incurred. Deferred settlement purchase. If inventory is bought on deferred payment terms, separate the financing component. Recognize the inventory at the present value of payments. The difference between purchase price and total payments is recognized as interest expense over the financing period, not included in cost. Inventories acquired through exchange. If inventory is acquired in exchange for dissimilar goods, measure it at fair value. If exchanged for similar goods, retain the carrying amount of the asset given up. Document the basis and valuation evidence. Disclosure requirements. Disclose your inventory accounting policies, including the cost formula used. Report total carrying amount and classification, raw materials, WIP, finished goods, stores and spares. Disclose inventories carried at NRV. Amount of inventories recognized as expense, COGS, write-downs and reversals, and inventories pledged as security. Clear disclosure helps users assess inventory quality. This. Example of disclosure note. Note X. Inventories. Raw materials, 10 lakhs rupee. Work in progress, 5 lakhs rupee. Finished goods, 8 lakhs rupee. Stores and spares, 1 lakhs rupee. Total, 24,000 rupee. Inventories valued at lower of cost and NRV using FIFO. Keep the note concise and factual. Comparison with IAS2, IND AS 2, is converged with IAS2, IFRS. Measurement rules, cost formulas, and NRV concepts align closely. Local disclosures may be supplemented under other IND AS requirements, but the core measurement logic is the same. Common pitfalls. Avoid these mistakes. Using LIFO, not allowed. Capitalizing abnormal waste or general admin overheads. Forgetting to reverse write-downs when NRV recovers. Using product line NRV indiscriminately instead of item by item where necessary. And misclassifying service inventories as WIP. Journal entry illustration. A. Purchase of inventory. Dr. Inventory, credit, accounts payable. B. Recording consumption. Dr. Cost of goods sold, credit inventory. C. Write down to NRV. Dr. Inventory write down expense, credit inventory. D. Reversal of write down. Dr. Inventory credit other income reversal. Narrate each with the period and reason for audit clarity. Analytical metrics. Useful inventory KPIs. Inventory turnover ratio equals COGS divided by average inventory. Days inventory outstanding DIO equals 365 divided by inventory turnover. Write-down percentage equals inventory write-down divided by total inventory. High DIO can signal overstocking. Falling turnover may indicate obsolescence. Interaction with other standards. IND AS2 links with IND AS1 for presentation. IND AS10 for post-reporting period changes in NRV. IND AS115 for WIP under revenue contracts. And IND AS23 for borrowing costs. Always check related standards when complex items arise. Practical example. Unit cost, 500 rupees. Selling price, 600 rupees. Selling costs, 120 rupees. NRV equals 600 minus 120 equals 480. Since NRV, 480, is less than cost, 500, value inventory at 480 per unit. Write down per unit equals 20 rupees, recognized immediately in P&L. Closing summary. Measure inventories at the lower of cost and NRV. Choose a consistent cost formula, FIFO or weighted average, and apply it faithfully. Exclude abnormal costs and only capitalize borrowing costs for qualifying assets. Write down inventories when NRV is lower. Reverse write-downs when justified. Good inventory accounting protects profit accuracy and balance sheet reliability. Final takeaway. IND AS2 ensures inventories, often the largest current asset, are not overstated. Cost shows what you spent. NRV shows what you'll recover. Balance prudence with accuracy. Document your choices and disclose clearly. Get this right, and your reported profit will be both credible and informative.